Once you understand the definition and the concept of all these asset management ratios, the calculation should not be too complicated. So for example, the first one, inventory turnover, that's sales revenue minus the inventory balance. So sales is 315 in 2018, and inventory balance is 111 from 2018. So that's how we got 2.84 times for this company. This is a little bit higher than the industry average. So we think that's a sign that the company is managing its inventory pretty efficiently. We can also look at the accounts receivable turnover. Accounts receivable is 70 million. That's from the balance sheet. The numerator is the credit sales. Now, in this case, all sales are credits, so we are using actually the net sales 315 divided by 70 million accounts receivable. That's how we got the accounts receivable turnover. When we look at the account payable turnover, we're using the cost of goods sold, which is 133 here, divided by account payable, which is 55 here. So that's how we got 2.42. Again, sometimes you may use the sales amounts in the numerator divided by the 55 million account payable. So either way is actually okay. So whether you need to use sales or the cost of goods sold in your exam, I will let you know clearly in the exam question. So then you will just do the calculation accordingly. If we look at the company's fixed asset turnover, net fixed assets is 315. The sales revenue is also 315, so that's how we got 1 times as the fixed asset turnover. Now working capital is the 205 current assets in 2018 minus the 123 total current liabilities. So sales 315 divided by the net working capital. The right result for the sales to working capital should be about 3.84 instead of the 3.71 here. Again, there is a typo here. The current liability should be 123 million instead of 120 million. So that's a mistake by the publisher. Total asset turnover is sales divided by the total asset. Sales from the income statement 315 and total asset 570 from the balance sheet. So total asset turnover is about 0.55, a little bit higher than the industry average. So by all these ratio results, the general conclusion here is this company has a little bit better asset management than the industry average. The results show that per dollar of inventory, the company produced more sales. Also, based on the average collection period, the company collects its accounts receivable a little bit faster than the industry average, and it pays its account payable a little bit slower. And per dollar of fixed asset, the company produced more sales. Also per dollar of working capital, total assets, all those ratios are showing that the company are producing more sales. So overall, good asset management in this company. The next group of ratios we want to talk about is the debt management ratios. Debt management ratios is about how the company manages its debt. We're looking at this issue from two perspectives. We want to see how much debt this company has, or say we want to look at ratios that measures the level of debt. And then we are concerned about whether the company are able to pay off its debt. So we need to look at ratios that is about the ability of the company to cover or say to service its debt. So within the group of debt management ratios, we also have two subgroups of ratios. Now let's see how much debt this company have, the level of debt. As you may recall from chapter 2, when the company issued debt, it gives debt holders the first claim and it promised to pay principal and interest back to the debt holders. So if the company does pretty well, then leverage can increase the return to stockholders. We demonstrated this back in Chapter 2. However, financial leverage can also increase the risk. So if the company is not doing so well, having debt, or say having too much debt, actually can make things worse. So the larger of the fluctuations of the company's cash flows, the greater need for an equity cushion. So the company needs equity as a cushion to survive some financial difficulty, because otherwise without equity, having too much debt potentially drive the company into financial disaster or bankruptcy. To decide an ideal level of debt versus equity, or say how much debt does the company need to have, how much equity do they need to have, we need to consider the trade-off between this value magnifying effect of financial leverage, but we also need to consider the risk of not being able to make the promised debt payment, or say the risk of bankruptcy. To see how much debt this company has, we look at three primary measures: the debt ratio, debt to equity ratio, and the equity multiplier ratio. Debt ratio simply is about how much debt, total debt this company has, comparing to the total asset they have. So this is about a percentage of total asset that is financed with debt. If we compare the amount of debt with the amount of equity this company has, that's the so-called debt to equity ratio. We can also look at how assets compare to the equity, or say how many times is the asset over the company's equity. This is called the equity multiplier. So if a company has 1 million equity but 5 million total asset, you can think of that as total asset is 5 times of the total equity, and of course the other 4 millions are provided by debt holders. All these three measures actually are related to each other. For example, if a company has 1 million equity for 4 millions of debt, so that the total asset is 5 million, then the debt ratio is 4 out of 5, which is 80%. Debt to equity would be 4 million over 1 million, that's 4. 4 plus 1 will be 5, which is 5 million asset over 1 million equity. You can also think that that 5 is the same as 1 divided by 1 minus the 80% debt ratio. So again, all these three measures are related. If you know one, you can figure out the other two. To understand the company's ability to cover, or say to service, to pay back its debt, we look at the coverage ratios. In your textbook, they used several coverage ratios. The main one that we are interested here is the times interest earned ratio, the TIE ratio. Simply put, TIE ratio is how many times the company's EBIT is over its interest expense. And as you can see, both numbers are from the company's income statements. If a company makes more EBIT than its interest obligations, the company apparently can make a profit. If EBIT is actually lower than interest expense, you can make the conclusion that the company simply doesn't make enough profit to cover its interest expense. So this is a ratio that indicates whether a company has taken too much debt. We'll take a look at next slide to see how the company's debt management ratios are calculated. So to calculate the debt ratio for this company, we are looking at all the debt. So that includes total current liabilities, which is the 123 here, and 192 long-term debt. So both short-term and long-term debts together over all the total assets. So that's 570. So that means the company has almost half, like about 55.26% of its total asset financed by debt holders. Now, debt to equity ratio will be the total debt, again, 123 plus 192, now divided by the equity amount. Total equity is 255. So debt to equity ratio is about 1.24 times. So that means debt holders contribute about 1.24 times of what equity holders contribute into this company. Equity multiplier will be total asset over total equity, so 570 over 255. Time interest earned as one of the coverage ratios calculated based on the income statement numbers. So EBIT in this company is 152 divided by the interest expense, which is right below the 152 here. So 152 divided by 16, that's about 9.5 times. So that's how many times its EBIT over its interest expense. So it looks like the company makes plenty of money to cover its interest obligations. The next group we look at is the probability ratios. And these probability ratios try to give us some idea about, of course, how much profit this company makes. And profit is a result of everything that's going on in the company, including the liquidity, asset management, debt management. So we are looking at the effect of all these on the overall profits, or say operating results of the company. Investors really care about how much profit this company makes. Usually if there is any news or any unexpected change in these probability ratios, you can see that stock prices can react very quickly. So if there are good news about the company's probability, stock price can go up, and if there's bad news, stock price can go down. We first look at the so-called profit margins. Here you can see there are 3 different levels of profit margins. So we have the gross profit margin, operating profit margin, and the net profit margin, or say the profit margin. Gross profit margin simply is the amount of gross profits over the sales. So if we look for the gross profit in the income statement, compare that with the sales, we get the gross profit margin. Operating profit margin usually is calculated by the operating profit, or say the EBIT, divided by the sales revenue. Net profit margin is net income available to common stockholders over sales. So that is the percent of sales left after all the expenses and payments are made in the company. So eventually how much of the sales is left to common stockholders. If the company pays dividends from its net income, we can also look at how much it pays as dividends. So dividend payout ratio is the amount of common stock dividends divided by net income available to common stocks. Now let's look at 2 return ratios. We first look at the return on assets. Return on assets simply is about the overall return on the company's assets. So that's net income available to common stockholders divided by the total assets. We also have the return on equity, which is more about common stockholders. So that's the return on common stockholders' investments. If you look at the formula, it's the net income available to common stockholders divided by the common stockholders' equity. We generally want the company's ROE to be high. So high ROE is usually a positive sign, but we need to be careful because sometimes a high ROE is brought by the high leverage of the company without any improvement in the actual probability. We'll explain this a little bit more when we talk about the so-called DuPont analysis. To calculate these probability ratios for this company, let's see. Gross profit margin is using the gross profit, which is 182 here from the income statement, divided by the total sales revenue 315. Operating profit is using the EBIT, which is 152 here, divided by the 315 total sales. Net profit margin, or say the profit margin, is about the net income available to common stockholders, 80 million here, divided by 315, the net sales. If we look at the return figures, we need net income available to common stockholders, 80 million, divided by total asset, 570. That would give us the ROA. If we use the 80 million divided by 250, which is 40 million common stock, par value and paid-in capitals, and the 210 retained earnings, so that's a total of 250 common stock equity. be careful here, we are not going to use a total equity of 255 here because this 255 actually include 5 million preferred stockholder equity, and we want to focus on only the common equity. Net income available to common stockholders 80 million, and out of that the company pays 25 million dividend to common stockholders. So 25 out of 80, that is 31.25% dividend payout ratio.